All right. Well, it is time to bring in our guest, Tony Dwyer. Tony is from dwyerstrategy.com at Canaccord Genuity. And Tony joined Canaccord following the acquisition of Collins in March of 2012. And you're currently serving as the head of the U.S. Macro Group, chief market strategist, and a member of the Canaccord U.S. Operating Committee as well. So I'm very interested in seeing your presentation, Tony.
Well, thank you very much, Aaron. I really appreciate it. Do you see it up there?
I do.
That is so excellent. So Tom and Aaron, thanks for the opportunity. And Tom, just quickly to kind of give the audience a little bit of history here. So we had expected, and we actually did a CNBC special about a correction call in late September, early October. We did two different things. I never expected a 20% market event. I expected a typical pullback. The algos took over, the structure of the markets, different now with the Volcker rule, all that fun stuff. So I never expected a 20% decline, but it was ripe for a correction and an increase in volatility. Back then in September, you had a VIX at 9, you had investors intelligence newsletter writers were 62% bullish. You just had this environment that was ripe for it. We're not there now, but so what happened is down by the December low, as you guys know, and Tom, you mentioned, every single technical indicator you could find had hit a historic extreme, whether it was sentiment, the stochastics. Like on Christmas Eve, I follow the weekly stochastic on the S&P 500, 14-week stochastic with a 3 smooth. It has never in its history closed at 0, and it was at 0. So it closed below 5, and it was literally at 1. So the market was ripe for a reflex rally, which typically when you get that oversold, it's about 14% in what we call a crash environment, which is any drop is 17% in 3 months or less. So the bottom line is you had this environment in September that was ripe for a pullback, not 20%. And then it gotten so extreme in December, it was ripe for a reflex rally. What changed the call that both of us thought would happen, which would be kind of a double bottom, a test of the low, was the thrust indicators, right? Like the breadth thrust indicators were extraordinary in early January at 90% upside volume days. The Lowry's folks, point that stuff out. You just had this kind of Jason Goford at Sentiment Traders mentioned a lot of the sentiment things that kind of had this reflex that created a breadth thrust and a thrust in the market. And that's why we changed from thinking that you were going to get a test of the low to kind of a giddy up and go environment. So the theme that I would like to hit on now is the 3 things that people are focused on, that the yield curve inversion in bonds are telling us something. Number 2, that the global growth slowdown is bad. And number 3, that there's an earnings recession that's going to drag stocks down given the reflex rally. In other words, it's just still a reflex rally and it's not fundamentally driven. So here at Canaccord Genuity, we have a core fundamental thesis. And the core fundamental thesis, Tom, you mentioned inflation this morning. It's driven by inflation. But I've been doing this a while and I'm really good at being wrong. So what I try to do is follow the things that aren't wrong. And I know that the market correlates with the direction of earnings. The direction of earnings drives economic activity. Economic activity drives the slope of the yield curve and availability of money. That's driven by Fed policy and that's driven by core inflation. So the core inflation actually has been a pretty good indicator of this is just to show you guys the backup. I'll never say something that I can't put in a chart because otherwise I'm making it up. You should be able to show it on a picture. If you see a lot of written text from me, I'm making stuff up. So here the correlation you can see is in 0.946 of the direction of earnings to the S&P price itself. So it's driven by core inflation. I like to joke with people, you don't have to be a master economist to look at this chart and know that inflation's low. Not only is it low historically, it's actually turning lower recently. And that was made true of the core CPI this morning, which is at 2%, down from 2.4% in 2018. So what gives the Fed room? President Trump put a lot of pressure on the Fed. People are focused on that. What gave the Fed the opportunity to pivot on this dovish pivot was the fact that core inflation had peaked out and started to come down, especially when you look at the 5-year inflation break even. You hear Fed Chair Powell talk all the time about how they look at what the market expectations of inflation are. Well, here's what the 5-year expectations are, that in 5 years, inflation will be at 1.81%, right? If you look at prior cycles, it's below where it was in 2005, well below where it was in 2005. It's even below where it was in 2018. So between the core inflation rolling over and the 5-year inflation break even not showing any kind of real problems, it gave the Fed an opportunity to do a dovish pivot. Average hourly earnings are in an uptrend, but again, similar to inflation expectations, average hourly earnings are still below where they were last cycle. So I'm really hard pressed to say that the Fed is actually going to be worried about inflation when, think about this, guys. You've had every monetary authority in the world has printed money for years now. The U.S. is at absolute full employment, with the unemployment rate being below where it's been in the past. It's at a historic low. And you can't get inflation above 2%. You know, if you're the Fed, you're a lot more worried about disinflation than inflation, which is why we think they're going to actually cut rates later this year. So page 6. This page is a great one because it's the real Fed funds rate. It's the real Fed funds rate using what the Fed uses, the core PCE. Now, what you see is 4 arrows there. And you'll notice that every economic cycle, the peak in the real Fed funds rate is lower. You know why that is? You know, I won't make you guess. It's because there's more debt. You cannot fix debt with exponentially more debt. The more debt you have, the less of an interest rate increase you can take before you get into delinquency and then defaulting on that debt. So each cycle has brought with it an increased use of leverage. That increased use of leverage has caused a lower real Fed funds rate. So on to the bank lending practices. So we have low inflation. We have an easy Fed. Neutral rate is 0, right? So the Fed is neutral. And you actually have banks willing to lend. Now, this might be too much information, guys, but, you know, on Christmas Eve, I'm home, I'm sitting in the hot tub, and I'm trying to figure out what the heck is going on. I got a market collapsing, but none of the credit market indicators like this one were scary. So I called the bank CEO and I asked him, what do you think, you know, what's the backdrop of lending? Bank CEO said to me, is a friend of mine, said to me, I don't get it, Tony. I can't lend enough. I want to lend more. I need more demand because all the demand is going to the shadow bankers. So no, non-traditional lending. It's hard to have a credit crisis when banks are trying to lend more money. You can have a credit panic. We kind of had that, but you can't have a credit crisis when banks are still willing to lend. And what really drives that is this chart, which I call the mother of all charts. You can see that this is the spread between the 2-year and 10-year yield curve. Now, there's a monster debate going on about this because the 3-month 10-year inverted, the 1-year 10-year inverted, but the 2-year 10-year did not invert. And it's an important point. Here's why. The 3-month and 10-year yield curve is what, or the 1-year 10-year, is what makes banks lend. So if you were a bank and you got your money at 4%, would you lend it at 3%? Of course not. You'd lose money. That's why the yield curve is important for banking. It's not a market indicator as much as it is a money availability indicator, right? So if banks are getting their money more expensively than they can lend it, they're just going to stop lending. That's like common sense 101. That inverted, which tells you need more than a couple of days, which we got, but the 210 did not invert. And the reason that I used and focus on the 210 now is because so much more of lending is being done in the non-traditional bank lending market, which is not funded by a deposit base. Quicken Loans, the Rocket Mortgage, doesn't have a deposit base that they can take and lever into loans and use for loans like a bank does. So they got to go out and get the money. Typically, they get it at 2 years. So if something like 50% of mortgage lending is done in non-traditional bank lending, like a Rocket Mortgage or a Navy Credit Union, how do they get their funding? Well, they get it on the 210 spread. But let's say, just for giggles, the 210 spread inverts in the next 15 minutes. All of a sudden, it just goes, you know, bonkers. It's actually historically a buy signal. And forget about whether it should be or shouldn't be. Let's get over that. Look at what it is. The table's right there. You get a median gain to the peak of the cycle of 21% over 18 and a half months, with a recession starting 19 months later. If you just look at the last 3 cycles, which are more similar to the current low inflation, high leverage cycles, you had a 34% median gain over 22 months, with a recession not taking place for a little over 2 years away. So to say that the yield curve inverted 2 weeks ago, even if it, which it didn't on the 210, but let's say it did, it's a buy signal. It's not a sell signal. All you got to do is look at the data. There's only one negative data point there, and that was 1973, when you had a heck of a lot more going on than we currently do. So low inflation, easy Fed, yield curves given money availability for banking and shadow banking, and non-financial corporations can afford it. Look at the bottom half of this slide. The interest coverage ratio is well above mean. I'll just ask you guys or anybody that'll listen to me, what makes you stop spending money? Well, you don't have any, right? Or you can't afford your mortgage and all your disposable payments are going to credit cards or whatever. Companies have cash flow and interest coverage ratios still well above mean, which means even though they are way highly levered, they can still afford the debt. And therein lies the real rub. I'm friends with all the kind of, I don't want to call them perma bears, but the more bearish ilk among us, because I've been in their camp. I'm in their camp, and I'll be as bearish as I've been bullish for the last 10 years when credit is not affordable and it shuts down. Companies have too much debt. That is not up for debate. There's no way this ends well. But the statement kills so many portfolio managers or investors because they invest in, quote unquote, this won't end well years before they should. And that is exactly what's going on. There's too much corporate leverage, but they can afford it, right? As you can see here, that's also reinforced by the bottom slide, which is high yield debt to treasury spreads are trending back toward their low. You can see on the top half, that blue line is the Barclays high yield corporate bond yield has come down, as has the treasury yield. Where you got to worry about this is when treasury yields are tanking and corporate yields are spiking. Just simply not the case right now. So when you look at the bond market, you know how at the end of last year and into early part of this year, people were saying the bond market's telling you something, right? It's quote unquote telling you something because that top half, you've seen such a drawdown in bond yields for the 10-year. Well, you got to be careful when you say that and make sure that you got to figure out which bond market is telling you something. Because the top half is a treasury bond, which people are telling you you're going to a recession or near it. The bottom half is Barclays U.S. Corporate High Yield Total Return Index. And it'll call me crazy. That kind of looks like an uptrend to me. It made a new high. It's making new highs every day. So be careful to think that the bond market's telling you something in isolation. You have to look at all the overall areas of credit. And this is my favorite checks and balances. I wake up, I think a lot of people probably think I wake up every morning and figure out how to be bullish. But I wake up every morning trying to figure out where I'm wrong and why I'm wrong. And on page 12, this is the checks and balances to all my other credit related stuff. This is the Chicago Fed National Financial Condition Subindices. You can get them. Go to the Chicago Fed website. You can track it yourself. You don't need my chart. I'd love it if you want to subscribe to DwyerStrategy.com, or if you're an institution, call our desk. But the bottom line is you can get it from the Chicago Fed. It measures 105 indicators, credit stress indicators. So the way I figure it is if it is different this time, or if there's something in credit that I don't know about or I can't hear about from other people, surely it's going to show up somewhere in 105 indicators that measure credit stress in banking, shadow banking, and the financial markets. You can see what was going on in December. Nothing. There was nothing going on in December. There was nothing going on in 2016. A little bit of problems in 2011, but even then you didn't get anywhere near where you've been at the recession level. So I think it's an important thing to have a checks and balances chart. Now, from a growth perspective, let's talk about this for a second. I think we're in a 1995 scenario. And if you think you remember what 1995 was like, you better go to the library and microfiche some of the articles because you can't pull them off the internet. You know, there was no Barron's Business Week. They didn't archive things before the Wall Street Journal. They have not archived things and put them on digital prior to mid-1997. So the net of it is, I went to the library, I microfiched all the Barron's and Business Weeks, and what I found was in 1994, the Fed doubled rates. They almost drove the economy into a recession. You got the yield curve down to 7 basis points. The growth, you went from very strong growth, even through the first, 3 payroll reports in 1995. You got really good growth, but the Fed was starting to worry about housing, autos. So they made their last rate hike in February of 1995. And by the way, 1994, you had 2 10% pullbacks, one in February, one in December, very similar to this past year. Anyway, bottom line is the Fed went from tightening in February of 1994 to cutting interest rates in July of February of 1995. They actually cut interest rates less than 6 months later in July of 1995. The reason that's important is, trust me when I tell you, if you go back and read the Fed minutes from 1995, in February, March, April, there was nobody saying on the Fed, wow, this is really tanking, we need to cut rates. Market goes up 20% for the year by the July rate cut in 1995. Clinton was being sued by Paula Jones. The Whitewater investigation was taking place. So you were, what his way to deflect that was, he created a potential trade war with the second largest global economy, Japan, which was about the same size as China's economy for global GDP today. So you had a Fed that had to pivot. You had the market up 20%. You had the Fed cut rates, even though people early in the year thought they were going to hike them. Sounds kind of like a bad setup. Well, the market kept going up, as you know, into really the 1998 peak. When you look at this chart in front of you, look at the 90s, you can see that there were 2 quarters in a row that were at less than 1% growth. Those were the first 2 quarters of 1995. So the point is, I got to move my little text box, but that's right to the right of where that 3.2 is on the screen, on the top half of that screen. So you had an environment where you almost shut down credit, but you didn't. The market was ripping. The Fed cut rates. And by the way, they cut rates in December after the market was up an additional 15%. Okay, so what's another checks and balance? We're not near a recession. This is the ISM Manufacturing Optimism Index, which has shown that over the history of this index, you have a recession from the date you make a peak, the cycle peak, which you could call last August, 31.5 months before your next recession. You can see that up into this last month, you had a drop in some of the ISM services, non-manufacturing components, but that made the new orders and business activity made a new high 2 months ago. And this is the Small Business Optimism Index, which leads the recession. Its cycle peak leads the recession by 41 months. So I got the yield curve telling you it's going to be 2 years. I got the ISM telling you it's going to be almost 3 years. I got the NFIB Small Business telling you it's going to be almost 4 years. I'm having a hell of a time saying that we're going to have a recession in 2019 or even 2020. So what I'd like to talk about a little bit is housing. Right? How does the economy grow? I think people forget the stimulative effect of the long-term interest rates coming from 3.25 down to 2.60 in this most recent move. What you have is the home ownership trend on the bottom part of this slide 19 is coming up from historically low levels, and it's being driven by the millennials. Right? You can see the millennial demographic. The peak birth year is 1990. That means, I don't know, just ask, I could ask you guys and you could ask anybody, if you have a millennial in your household, do they know anybody going to a wedding this year? Most of them would kind of chuckle and say, yeah, somewhere between 5 and 10 of them. The millennial demographic was not unique to any other demographic. I like to say that I was a millennial. You know, when I was 25 years old, living in New York City with 2 of my buddies from college, wasn't thinking about having a mortgage or 2 car leases. Fast forward to when I had 2 kids, one and one on the way, out to the burbs we go. Very similar to what's happening with the millennial demographic whose peak birth year is turning 30. So we got banks that are willing to, inflation is allowing the Fed to keep interest rates low enough. And banks have money availability and are easing their lending standard, have easier lending standards still. So I have low inflation, easy monetary policy in theory, low interest rate environment. I get a demographic tailwind that is pushing housing in the U.S. by the home ownership rate going up. This graph on the left side is the global manufacturing purchasing managers indices. Green is good, red is bad. You can tell most of the world is green outside of Europe. Comes as no great shock. Global services PMIs on the right are the same kind of thing, where most of it's green. And what we have is a lot of people are talking about the global growth being in a bad spot because you have such weakness. The IMF lowered their growth expectations last year. Just look at this chart, guys. Breadth of manufacturing purchasing managers indices globally. When was the time to get cautious? It was in the very end of 2017. That's your time to worry about global growth. Time to worry about global growth is not when this number is below 20, and it sure as hell isn't when the share of PMI's new export orders on the bottom are near zero. That's when you want to start thinking about a turn. So what's a sign that you could have a global turn? I was on CNBC the other day doing the closing bell, and they looked at me like I had 10 heads 3 weeks ago when I said that there's signs of a global inflection. Do you ever notice that the second derivative is only talked about when it's negative? When you have a peak reading and it's turning over, like in the beginning of 2008, nobody ever talks about the second derivative when it's actually turning up from a wicked low level. And that's what we're seeing on the OECD leading indicators that measures 36 global economies. And what you're seeing in the middle chart that you inflected a few months ago on the month-to-month data, on the CLIs posting monthly positive changes. And if you look at that, that turns before you turn the year-to-year changes on the bottom or the overall index on the top. So I'm throwing a ton at you. But the point is, you got low inflation, easy Fed, still positive yield curve, which is incentivized lending, a demographic tailwind. Global growth has already been beaten up. It's not the time to get negative there. So how do you have an earning? What's an earnings recession? What causes an earnings recession is a drop in the price of oil historically. A non-recession earnings compression comes from a drop in the price of oil. That has been more than recovered. To give you an idea, since we're starting earnings season later this week, in the next couple of days with the big banks reporting, what's interesting there is in 2016, 15 and 16, when you had left earnings recession, it came with negative revenues and negative earnings. Revenues, according to IBIS, should be up 5% this quarter. So I said revenue, top line growth, is going to be up 5%. The current consensus is calling for a 2% drop in actual earnings, S&P operating profits. Historically, through this cycle, you've not had a single quarter where the number that started the earnings season, which would have been April 1st, has not been revised up by the time that the last company reports, with a median gain of 3.5%. So what that basically tells you is if the current number is -2, the end result should be plus 1.5 if it hits the median. 80% of the time, the increase in the number from the first day of the reporting season is over 2%. So it should be, you've got huge odds of not seeing an earnings recession actually having a positive number for Q1. So I think that's a really interesting time to be able just to show you the backup to that. There's the backup to that on page 32 of the slide deck here. You can see that the fourth quarter of 18, you had a 1.1% differential, and you can see the data. It's pretty consistent. It's very consistently positive. So when you look at what all that means, you've had a multiple compression because the market crash, non-recession market crash in the fourth quarter. So here you can see that trailing 12 PE has dropped from over 20 down to, I think it's like 17 now. The interesting thing is when you look at it historically, when core inflation is between 1% and 3%, you traditionally get your average multiple is 19 times. So not only is it not a stretch because you were there for 2 of the last 3 years, but that's your number. So if you get a target of, a year out, call it 19 times, our number's 168. It's somewhere north of where we are today. And just lastly, I would like to just remind everybody, don't focus on somebody's target. I'm like the poster child for this. The reason is you're trying to pick the right point in time and the right valuation. Focus on the process like I just walked through versus what a target is. You know, this is a bull tape still. I don't think it shouldn't change. Could it pull back a little bit? Hell yeah, it could. We're up straight up almost 25%. You've had some, you know, a few technical divergences, new highs, things like that. But I can't find any data that suggests that once you get this breadth thrust, that you have a tank later in the year. So, Tom and Aaron, I kind of went on too long probably, and I went real quick, but I wanted to get it in there, and I can take any questions.
Well, I can tell you right now, my head is spinning.
Yeah, I bet. Mine is too.
In a good way, in a very good way. I thought the presentation was excellent. I think actually it's probably one of the best presentations we've had here on Market Watchers Live, being totally honest, and not just because you're bullish, but I think the arguments that you made and the information that you shared, I think was spectacular. So really appreciate the presentation. And I will go back and go through this presentation one more time, because you threw a lot at everyone, but you got a lot of arguments backed up by facts. So very good presentation. Really enjoyed it, Tony.
Thank you.
Okay, couple of questions here. One, and I think you covered this a little bit. Some of the questions came in, and then you continued doing your presentation. So I think you may have covered some of this. But if you're looking at our economic cycle right now in the U.S., where do you see us still in the early stages? I mean, do you think this goes on for quite a while? I know you said you don't like to try and give targets and that sort of thing, but do you think we're still like in the 4th inning of a 9-inning game, or do you think this is 7th or 8th inning?
All right, so this is kind of an interesting question, because if you think about it, let's go back. I'm going to take you back to a chart that'll answer the question. Like, if anybody ever answers these questions without giving you data, you should short them. Okay, you see this chart here with the real Fed funds rate? Mm-hmm. You see in the last 3 cycles, Tom, they've been longer each time at the lower level of the real Fed funds rate. Mm-hmm. Right. So in the 1990s, you were only there for like a year and a half at the low and negative rate. Then in 2002 to 2005, and now you did it from 2009 to 2016, almost 2017. In other words, the amount of leverage that we're having is making the cycle be extended, because it takes you longer to dig out from the crisis. Mm-hmm. Right. Once you go into a credit crisis. So the innings, we were in the early innings of the game for 7 years. And we're in the middle innings now, where the Fed is raising rates to the point where they're going to invert the curve. Once they invert the curve is when you go into the later innings. We've yet to invert the curve. So I would say economically, we're towards the later part of the game. But the first part of the game was like they batted around the order 4 times.
Mm-hmm. Yep, I got it. All right, I've got a question for you. And you talked a lot about the 10-year Treasury yield and the 2-year Treasury yield and the spread there. And of course, when I was before I got in, started working in technical analysis and dealing a lot with the stock market, I'm a CPA, so I audited companies. I actually worked a lot with banks, so I was following a little bit what you were saying. And of course, as this spread between the 10-year and the 2-year continues to dwindle, that's not usually a good thing for banks, their bottom line, because their net interest margins are shrinking and so forth. So given the backdrop in what you're seeing with the 10-year Treasury yield and the fact that we're now getting close to that zero line, the 10-year looking, versus the 2-year, do you think, looking ahead, that this is an opportunity? And I'm not talking about any individual stocks. I'm just talking about the group of banks. Do you think that because they have outperformed during this whole period, really the last year or so, with the 10-year Treasury yield dropping versus the 2-year Treasury yield, do you think this is an environment where banks might make sense?
Well, and maybe one of the worst calls in my career, I've been overweight banks for a while. Yeah, I do. And the reason is I go back to that 1995 analog, and what kick-started banks was some M&A. We just recently had BB&T was acquired. They were a merger. So you had the same kind of thing in the early part of 1995. And again, what had happened back then is the Fed got the curve to about 7 basis points on the same exact reasons, Tom. You had the 10-year and the 2-year dropping, but the 10-year was dropping more at that time. Once that stabilized and reversed, which I think we're doing now, banks outperformed basically until 1998. So you still had a pretty good performance. So I would stay with the banks. I'm overweight the banks.
Okay.
I think one of the problems that I missed in this cycle, that I think a lot of us missed about the financials and the banks, is I don't think it's as much yield curve driven. I think lending is being more impacted by shadow banking competition. You didn't have the rocket mortgage in past cycles.
Mm-hmm. Good point. Very good point. All right. I got one more question for you, and I'm going to let you go. I'm going to pull up
Awesome.
on my screen here. I've got a chart here of the U.S. dollar, and you didn't talk a whole lot about the dollar, but back in 95 to 2000, we had a very strong bull market with a rising dollar. In 2002 to 2007, we had a bull market where we had a falling dollar. Over the past 10 years, we're now back into an environment where we're seeing the dollar rising. My question, just from a macro perspective, how much attention do you pay to the dollar, number one? And if you do recognize that we're in an uptrend here, how is that impacting your portfolio as far as like which areas of the market you favor?
So it's a great question. If you look at the dollar, at the U.S. dollar on this chart, you notice one thing. It hasn't changed a bit since the end of 2014.
Mm-hmm.
Like I don't necessarily know if it's as much as an uptrend as you're consolidating that spike. So I frankly don't know which way to go. I would have said that you broke that out in late 2016, which totally failed. Then you totally broke it down in 2017, and that failed. I don't know what this chart's telling me. I got a big fat neutral on it. So I think right now, until it really has a significant move one way or another through the top end of that range or through the bottom end of that range, I think it's one of those great media-driven, overblown calls that I'm not willing to make, because it is literally unchanged over the course of the last 4 years, right?
Mm-hmm. Well, I know, we've been in an environment, for instance, in energy with crude oil prices surging again. But yet when you look at the energy ETF, the XLE, relative to the S&P 500, it's actually been going down, even though crude oil prices have been going up. And of course, one of the things providing those headwinds has been this uptrend in the dollar since 2011. So I was kind of looking to see maybe if there was any areas maybe that you would rule out until we see a definitive break to the downside in the dollar. But it sounds to me like you're still just kind of neutral.
I'm just kind of new, but think about this too, about, it's interesting because if you move your trend line and you just make for the range, it really, like I said, it hasn't moved really in 4 years. So I think the underperformance relative to the price of oil, I'm wondering if you wanted oil exposure, you used to have to buy an oil company. Now you can buy an oil ETF, correct?
Right.
Remember when gold stocks, gold was ripping and people were flabbergasted because the gold stocks weren't playing the game as well? And then I was thinking, well, maybe it's the gold ETFs. If you want gold, why would you take company risk? So I think that's having an influence on some of the commodities that we didn't have in prior cycles.
Very good. Very good. Well, it has been a pleasure having you on the show. I know our viewers certainly enjoyed this. I did. And like I said, I'm going to go back and review it again. So thank you so much for joining us today on Market Watchers Live. We hope you'll come back and join us sometime.
I sure will. Have a great day, and thanks for the opportunity. Take care.
All right. Thank you, Tony.